We can safely say that it was an eventful and chaotic month for Latin America. Some alarming market-moving events happened this week that could potentially set the region in a fundamentally different direction. We tell you what happened and how to profit from it in Banana Republic. We begin with Argentina, where Alberto Fernandez was elected president of Argentina, putting an end to 4 years of neoliberalist policies and potentially taking the country back to its Peronist roots. Following the victory, Alberto Fernandez had a transition breakfast meeting with President Macri. At the same time, the central bank tightened capital controls so that individuals can only buy $200 per month, compared to $10,000 per month prior to the elections. This will reduce the pace of drawdown of FX reserves. Now, attention will shift to 1. The composition of Fernandez's economics team, 2. His choice of economic policies, and 3. Negotiations with both the IMF and bondholders. Alberto Fernandez has ruled out a haircut on external debt in future reprofiling. Our view is that Macri has done most of the heavy lifting in implementing most of the macroeconomic adjustments required to stabilize inflation and the fiscal accounts. We also believe that former President Cristina Fernandez de Kirchner will not have much influence over economic policy. Lastly, we believe that the Fernandez administration has every incentive to drive an investor-friendly solution, as they need an open capital markets to fund Vaca Muerta. So how do we profit from the current situation? At Banana Republic, we believe that low dollar value Argentine sovereign debt offers extremely attractive risk-reward characteristics, with potentially 150% upside for a 15% downside. Namely, we believe that buying Bonar 2024 bonds at a price of between 30 and 30 cents on the dollar will offer this type of payoff. Next, we move to Chile, a country that is suffering its worst political crisis since the Pinochet dictatorship 30 years ago. At the heart of the problem is deep social dissatisfaction with inequality and the political class. President Piñera dismissed all his ministers in cabinet, reshuffled and lifted a one-week curfew after more than 1 million people protested in Santiago. Protests have been ongoing for some weeks, and 19 people have been killed and thousands injured. Piñera announced a package of social measures including a higher basic pension and higher minimum wages, canceled a 9% increase in electricity bills, and pledged to use state resources to help cover the cost of expensive medical treatment. The central bank cut its policy rate by 0.25% to 1.75% and maintained an accommodative tone as the protests weighed on business confidence. At Banana Republic, we are extremely concerned about the situation. Not only do we believe that the cost of damages to infrastructure, looting, and business interruptions will have a heavy toll on the nation, but we believe that the country will increasingly lean left to meet populist demands. We believe that you should not be owning any investments in Chile at the moment, and believe that the subdued price action is an opportunity to reduce or exit any exposure to the country. Moving on to Bolivia, the country is facing its own political crisis. Changes in election count showed a surprising surge in support for incumbent President Morales, who secured 47% of the votes versus 36% for centrist Carlos Mesas. This is his fourth re-election as president since 2006. This led to riots as the OAS expressed concerns over a dramatic and hard-to-explain change in the trend of preliminary results. The EU, the US, Brazil, Colombia, and Argentina have all expressed support for a runoff. At Banana Republic, we do not have any strong views on owning investments in Bolivia. In Brazil, we finally saw the landmark social security reform approved by Senate. It is expected that Brazil will save $200 billion in savings over 10 years by gradually increasing retirement age of new public sector employees and reducing various benefits. The country is also expected to reduce import tariffs for industrial durable goods from 13.6% to 6.4% over 4 years. Inflation continues to decline from 3.2% in September to 2.72% in October. Although Brazil has a lot of positive momentum, we believe the country's assets are priced to perfection and recommend avoiding owning financial investments in the country. Thank you for listening to this week's news. We encourage you to subscribe to our channel for more content on emerging market investments.